name is Giovanna Quiros. I'm the events manager at the USC Price School of Public Policy. Price Presents is the USC Price School's premier webinar series about issues confronting society that shape our daily lives. Each webinar features experts from not only the USC Price School, but across USC, as well as those from other universities, government, businesses, and not-for-profits. Today's discussion, titled Debt and Development, will be moderated by USC Price professor Richard Green. Though the audience will not be able to ask questions verbally, we encourage you to submit your questions through the Q&A function at the bottom of your screen, and panelists will respond to as many as possible. Now I'd like to turn over the presentation to Richard Green.
Thank you, Giovanna. And my name is Richard Green. I'm also director of the USC Lusk Center for Real Estate, and besides being a member of the Price faculty, I'm a member of the faculty of the Marshall School of Business and the Department of Economics here at USC. And it is my pleasure to lead this discussion. I'm just starting to think maybe pleasure is the wrong word, except that it is a pleasure to welcome my colleagues, Moussa Diop and Erica Jiang, about vulnerabilities facing the credit market sector right now and the implications that it may have for the real estate market, including new development and the sustainability of development that's been around for some time. Moussa is a colleague of mine here at the Price School in the Smith Department of Real Estate Development, an associate professor here. Erica teaches in the Finance and Business Economics Department at the Marshall School of Business. Moussa has done noteworthy work of the impact of changing Federal Reserve policy on the commercial real estate sector. Erica has done notable work on bank vulnerabilities that have arisen from the fact that the Federal Reserve has raised short-term rates sharply in an environment when many financial institutions have long-dated assets on their balance sheet. So I'm going to turn it over to them to talk about each of these things. Moussa, let's start with you, please.
Thank you, Richard. Thank you for the introduction. Also, thank you for inviting me to be part of this webinar. I have been here, I think, now for 5 years, and this is the first time I have the opportunity to communicate with the Price School. So again, thank you. And before USC, I was at UW-Madison, and my background is in civil engineering and banking. My research, as Richard said, focusing on real estate finance as well as on housing market. Okay, and yes. The real estate market right now is really hurting quite a bit because of very high interest rate, and we can talk more specifically about that. Development activities have gone down substantially, and also existing loans that do face refinancing also do face very high interest rates that may severely limit the ability of landlords to refinance their loans and be good on their debt.
Okay, thanks, Richard, and thank you so much for having me on the panel. I would like to start with an introduction of what happened in the banking sector in the past 2 years amid the rise of interest rates. And just to give a little bit of background about the monetary policies in the past 2 years, since March 2022, the Federal Reserve has taken very aggressive action to tame inflation, and the interest rates increased by about 5 percentage points from the first quarter of 2022 to the beginning of 2023. And so this rapid increase in interest rates significantly affected bank health because they engage in maturity transformation. And by maturity transformation, I mean banks take short-term deposits and lend them out in the form of long-term loans. And why could this be a problem when market rates go up? And this is because when rates go up, the value of long-term assets decline, just like what Richard said at the very beginning, as we can see from price declines of many MBS and CMBS ETFs. And banks hold many of those such assets on their balance sheets. And as this asset value decline to some extent, the uninsured depositors may start worrying that they won't be able to get their money back and therefore start pulling money out of their bank accounts. And when that happens, banks are forced to sell long-term assets at the market value, which is much lower than the book value in the current interest rate environment. And as a result, we have seen several bank failures in the past 2 years. And importantly, even if banks don't fail because of the interest rate risk, their ability to absorb losses on their existing loans could be significantly jeopardized until rates go up again. And unfortunately, what happened in the commercial real estate industry after the pandemic made it necessary to have a healthy and sound banking sector to help absorb losses. And there are two broad reasons for why commercial real estate has been viewed as having an elevated stress risk. And this is what I have been working on. So the first one is the fundamental risk. We know that the CRE has been facing increased business risk that has led to declining fundamental property values. For example, the office properties are under significant pressure due to remote and hybrid work patterns. And the lower demand for offices can also negatively impact the demand for other commercial real estate properties like urban retail, multifamily, and hotels. But my research has suggested that if the fundamental risk was realized before the rise of interest rates in March 2022, the banking sector would be able to absorb the losses and presumably help restructure the loans. So the main issue is still the interest rate risk. The rising interest rates made it difficult to refinance CRE loans, which elevated the financial risk of CRE, and most of the CRE loans are going to mature in the next few years, and declining property valuation and rising interest rates made it very hard to roll over the debt, which may lead to maturity default. And in one of my research papers that I'm going to share in the chat, we evaluate the fundamental business risk by looking at the value of properties backing the outstanding CRE loans. And we also assess the financial risk by looking at the operating cash flows relative to the current interest payments, as well as the potential new interest payments. And so the results don't appear to be optimistic. I'm happy to dive deeper into those as we go. Just briefly talk about what we find. Many CRE loans are actually underwater or have a pretty low debt coverage ratio, especially loans backed by offices and multifamilies. And about 5% of CRE loans are both underwater and have too little cash flow to cover their annual debt payments. And just take one more minute. And what's more concerning is that the two sides can actually reinforce each other. The CRE crisis could push more banks to be at risk by making depositors lose confidence. And the New York Community Bank is one of the examples. And in my research papers, we show that the interest rate risk has eroded banks' ability to withstand a 10% default on their CRE loans. And if the default risk is realized, this can make more banks at risk of depositor run. With that, I will just finish my opening remark. I'm happy to talk about any of the details.
Great, thank you. Well, I want to toss it back to Moussa. So we know that in terms of fundamentals, there is a big contrast between the office sector and the multifamily sector, because if we just look at occupancy rates in multifamily are still quite high. And interestingly, the places where they've deteriorated the most, places like Dallas and Atlanta, they're places that are actually not close to CBDs. They're just in places where there's been a lot of new construction. But some of the work you've done on, and so in general, multifamily properties are occupied, but because of these interest rate changes, they need to be throwing off more cash flow in order to get refinanced. And I know, Moussa, you've looked at that at some depth. So you could tell us sort of how do multifamily properties have to perform today relative to 5 years ago, just to deal with the fact that the cost of debt is so much higher than it was 5 years ago?
So multifamily properties have been more resilient than other properties because we don't get a lot of data on really loan performance from about the performance of loan held by banks. But the data we get is mainly from the CMBS market, and multifamily defaults are quite low compared to offices. But of course, the biggest, the safest loan these days are really industrial properties. The issue here that a lot of these owners face is the fact that commercial real estate loans are not fully amortizing loans. These loans are for a very short period of time, relative compared to residential mortgages. These mortgages are anywhere from 3 to 10, maybe 15 years. Okay, so what happened, as Erica was saying, the Federal Reserve did maintain interest rate very low since 2008. Okay, up to maybe the first quarter of 2016, the federal funds rate was almost zero. okay? And the Federal Reserve then started increasing interest rate. And as the pandemic hit, and they cut back rate to almost zero and then started increasing interest rate again to fight inflation, okay? And we believe that right now the Fed is almost at the tail end, as stop increasing interest rate, and we expect some more expansionary monetary policy soon, and maybe the Fed will start cutting interest rate. So if you go back, when we did the Kasdan report, we went back and tried to understand what kind of loans were at risk, okay? Because every year there are about close to, let's say, somewhere between $400 to $500 billion of commercial real estate loans that are due for refinancing due to the short-term maturity of these loans. They cannot be fully repaid, okay? And of course, now what we face is basically refinancing risk materializing, okay? This has always existed in the system, but you never know exactly what's going to happen because your loan can mature and the financial market may be in a state where it is very difficult to refinance. And this is exactly what a lot of property owners are facing right now. So we need to understand really which loans are maturing and which loans are at risk. And this is the analysis we did when we did Kasdan, okay? Those loans that are at risk are the loans that were originated during, let's say, 5 years ago or shorter, okay? Maybe basically loans that are 5 up to 6, maybe 7 years that are maturing now. Those are really the loans at risk because those are the loans that were originated when interest rates were very low, okay? Among those loans now, after you understand which loans are maturing, understand, it's important to understand what type of properties are backing those loans, okay? In commercial real estate in general, okay, fully stabilized properties don't get loans for 4 or 5 years or less. They get financed for 10 or maybe 15 years because it doesn't make sense to have short maturities for those loans, okay? The loans we see really maturing are loans on mostly transitional properties that have not been fully stabilized, and properties also because maybe some lenders, some borrowers did decide to refinance their construction loan earlier in order to basically reduce their financing costs. But understanding which maturities are due for refinancing is important, but understanding also which property types, okay? And also who are the lenders, okay? So a lot of these loans are multifamily. A lot of these loans are also office loans. You see few industrial, there may be some retail, but if we focus on the multifamily, which I looked at more carefully, a lot of those loans are really are loans backed by the GSEs, okay? And we believe that a loan backed by the GSEs are now—
Moussa, tell us what a GSE is, please.
Okay, these are the loans that are backed basically by the government-sponsored enterprises. These are Fannie Mae and Freddie Mac, because they are required to provide in their requirement to facilitate basically to make housing more affordable. They are required to provide lending for multifamily properties, okay? And a lot of these properties, a lot of these loans that are due for refinancing, close to, for multifamilies this year, for instance, because the biggest wave is going to be this year and next year. For multifamily, we are talking about anywhere between, let's say, 120, it's going to be about 125 billion this year. 80 of those billion of those loans are agency loans. So definitely, those loans will be very difficult to refinance, but because those loans were on transitional properties, a lot of those loans were really underwritten very tightly, okay? That may help. The fact that the GSEs are involved also may help, okay? So we can discuss that more in detail, but I just wanted to share that. It's important to understand which maturities, which loans are maturing, who are the lenders, and whether or not those lenders would be willing to work with borrowers. But the fact of the matter is also, a lot of borrowers and lenders did have a lot of time to think about it and to start to come up with some solution before those loans are due for repayment.
What's interesting, one thing about GSE lending is the way they discipline their borrowers is I've known, I don't know the current person who runs multifamily for Freddie, but I knew pretty well the two people before the current person. And what they said to me is, even though their loans have a lot of covenants in them and so on, that are beyond repayment, they don't actually care that much about that. And by the way, out there is, I do not speak for Freddie, I'm just repeating. But what they do care about is getting repaid. And so the story is, yeah, you can default on us, and it's non-recourse, which is to say you're not personally liable, but it means you'll never get a loan from us again. And we have very long memories. And so from a repeated game standpoint, even if people are upside down, they're going to have a lot of incentive to figure out how to pay those loans back some way. Now, the other thing, of course, this is outside the banking system. And I think, what did you say, Moussa, 80 out of 135 were GSE loans? Is that what?
Yeah, because if you look at, for instance, multifamily, a lot of these loans that are maturing, about 48% of those loans are from GSEs. Banks are exposed, as Erica said.
I was going to say, so what share are banks, would you say?
For multifamily banks, they do provide about 30% of the loans.
Okay, but so we're talking about roughly 40 billion of loans coming due to banks
just for this
right now, and I'm going to sort of throw it back to Erica in a second because I want her to bring home a point she was making. So in a world in which our largest banks have assets of over $2 trillion, 40 billion is actually a pretty small number in the overall scheme of things. And so it comes back to the point that Erica was making about interest rate risk. And so, Erica, I got a question from a viewer basically asking if you could walk through the mechanics of how interest rate risk creates problems a little more in a step-by-step manner, because for those of us who don't think about balance sheet mismatch all the time, I don't think it's obvious. So if you could just sort of give us a picture of what a bank balance sheet looks like and how this change in interest rates affects both sides of the balance sheet and the implications of that. I think that would be very helpful to our viewers.
Yeah, sure. So we know that banks take short-term deposits. So that is the majority of the liability, bank liability. They take those short-term deposits from depositors, and then they lend those deposits out in the form of long-term loans. And actually, after the financial crisis, many banks took on not only long-term loans, but also long-term securities like treasuries and also MBS on their balance sheet. And this creates a maturity mismatch, where on the right-hand side of the balance sheet is short-term, on the left-hand side is long-term. And when interest rate goes up, what's going to happen is the value of long-term assets will decline. Right? We know that you are going to collect cash flow from today to future, let's say 10 years from today and 20 years from today. And you discount all of those cash flows back to today to know what is the value of a property or what is the value of a long-term loan. And when the interest rate goes up, the discount factor you apply to future cash flows become bigger. And that makes the value today declines. But then at the same time, on the right-hand side of the balance sheet, banks have to offer a much higher deposit rate. Right? During a normal time, depositors are sticky and banks are able to offer a much lower deposit rate than the market rate. That is a good thing. But during a crisis, especially during the recent episode, what's happening is uninsured depositors, meaning that those depositors with bank accounts that has an outstanding balance beyond $250,000, that's the deposit insurance limit. Like for those uninsured depositors, they may start worrying that they won't be able to get their money back by looking at bank balance sheet. We all knew that SVB failed, and then depositors start panicking about whether they're able to get the money back. And then what they're going to do is they will start pulling money out of their bank accounts. When that happens, how can banks deal with such a deposit withdrawal? They are going to sell some assets if they have enough liquid assets like cash, for example, they could just use those cash to repay those deposit withdrawal. But until some point, if there are a lot of deposit withdrawals, banks need to sell some of the long-term assets like loans or long-term securities. And usually that's not the case if interest rates are high, right? If interest rates are still low. If interest rates are still low, then the market value of those assets, meaning that if banks have to sell those assets in the market, the money they can get from selling the asset would be very close to the book value on their balance sheet. But now the market rate is very high, so banks have to realize some losses by selling those assets, and that creates trouble, right? And so we have seen several bank failures in the past 2 years because of that. So this is what's going to happen in the very extreme case. But what was even more important for some of the borrowers, for local community, is even if their banks don't fail because of the interest rate risk, their ability to absorb those losses on their existing loans could be significantly jeopardized. Like I show in one of the papers I shared, if the CRE crisis happened before the rise of interest rates, so when interest rate was still low and we had such crisis, banks could definitely help. Just like what Richard mentioned, you look at banks' balance sheet, you look at total capital of the existing banking sector is high enough for them to absorb those losses. Because, I mean, it's true that banks hold a lot of CRE loans on their balance sheet. The total amount of CRE loans on their balance sheet is not that big to absorb all of the capital that banks have. The issue is the interest rate risk. Because of the interest rate risk, they already have $2.2 trillion unrealized losses. And now you ask them to bear additional 10% of CRE default, that's just not going to happen. And that's where the issue is. That's what I talked about earlier.
So I think let me just add a couple of things. First of all, for people who don't follow this stuff on a daily basis, which is 99.9% of the world, or 99, there is an approximation in finance called duration, which basically says you can look at the value of an asset and you look at its maturity, and you can look at how the value of that asset changes with a 1% change in interest rate. So suppose a bank has a 10-year treasury security on its balance sheet. Remember, there is no default risk here. Credit is not an issue. The money will be repaid as promised. Well, assuming Congress doesn't not repay, but let's leave that aside. Okay, if interest rates go up 1%, then the value of that asset falls by about 10%. Mm-hmm. And so think about what the Fed has done now is they have increased interest rates 5%. And so if you have long-term, now this has not happened interest rates on long-term assets, but they've gone from 2 to 4% very rapidly. So you think about that 10-year asset, interest rates go up 2%, the value of that asset is down 20%. So even if you're a well-capitalized bank, if you have nothing but these long maturity assets, and very few do, but you're broke as a bank in terms of you're a zombie bank. And it's not just that you can't absorb losses, you can't do any more lending right now. You're not in a position to give people money. And this is one of these things people might say, well, that sounds like theory. Is it true? If you look at what treasuries trade for, the theory exactly matches, not the duration approximation, because that is approximation, but when you do what Erica suggested, which is you take the new discount rate and you look at the remaining cash flows and you apply it, that is exactly what those bonds will trade on that day. So this isn't like some airy-fairy theory that has no grounding in reality. The theory actually predicts with a great deal of precision what the value of these assets are. So I would like to, I have a really nice question from an anonymous attendee, and it's for Erica, but it follows up very well on your point, is why did banks like Silicon Valley Bank and First Republic fail to effectively use hedges to at least mitigate a portion of their mismatch risk? And before you answer the question, Erica, I'm going to ask you to explain to the audience what a hedge is and how it works.
Okay, cool. So Many people actually ask us this question when we first document this $2.2 trillion mark-to-market losses. And the question comes naturally is, okay, we know that banks are doing this maturity transformation business, then they must be aware of the potential interest rate exposure. So what can they do? They can buy some derivatives, like for example, interest rate swaps that help them hedge against interest rate risk. When rate goes up, they can use those interest rate swaps to make sure that they are still paying the short rate and vice versa. And the question that, or the answer is very simple, is they don't hedge as much. As shown in the second paper I shared, we dive deeper into banks' interest rate swap positions. And we looked at call reports, which is the regulatory filings of banks, and also we looked into 10Ks, which is the public disclosure of what they're doing, what those banks are doing. We find a limited hedging activity. Or at least if we looked at whether the majority of the losses are covered by their hedging position, the answer is no.
If you look at our larger banks, though, many of them, so like Bank of America, if you look at their balance sheet, it looks problematic before hedging, but after hedging, it looks very safe, right? But are there any dangers of using hedging as a mechanism for insulating yourself against this kind of risk?
Hedging is costly. I think that is one of the problems, especially given that we were in a low interest rate environment for a very long time. When you hedge, you would hope that the rate would go up, right? If the rate go up, you can use your interest rate swap position and make sure that you are not losing. But if interest rate doesn't go up, that means you would have to pay for the hedging position. Actually, that is what happened to SVB. If you look at what they did in 2022, they actually sold many of the hedges. They closed many of the hedging position to realize gains from those hedging position. And we call that gambling for resurrection. They were trying to realize those gains in the short run. And then they bet that eventually if they fail, the government is going to help, or if rate actually drops in the near future, then they don't have to worry about interest rate risk anymore. And so if you, when we looked at their reports, they actually closed many of the hedging position, and SVB was not the only bank that did that.
So you bring about, so I have a policy question for both of you. I'm going to throw it open to both of you, but Erica, your answer took me back to the days of the savings and loan crisis, when, and a lot of people get this wrong, people thought the reason savings and loan failed was because of credit. And ultimately that was true, but really the reason they failed was because of interest rate risk. So they were in fact at the time forced to do the following business: to take local deposits and use that money for local mortgages. And that was basically the only business they were permitted to do. They could do a little bit of other stuff, but overwhelmingly their balance sheet had to be fixed rate mortgages that paid 5-6% interest. And the Federal Reserve, as we all know, in the late 1970s, started really cranking up interest rates. And I love to tell my students that when I had my first job out of college in 1980, my first CD paid 13.5%. And I think it was the savings and loan, actually, I got it from. But clearly that wasn't sustainable. So all these guys were zombies, which gave them the incentive to take really big risks for the reasons you said, because if the risk paid off, they get themselves out from under. But if they failed, well, they'd failed anyway. They were going to be covered by, their depositors were going to be covered by which was called the Federal Savings and Loan Insurance Corporation, something very much like FDIC at the time. So there was this enormous incentive to gamble. Are we in a similar position right now with respect to, well, because we know there are a whole lot of banks out there that, while the book value of their assets look fine, the market value of their assets is worth considerably less than what they owe to their depositors. Could we see lenders, bankers starting to do irresponsible things, and what can prevent that from happening? And I'm going to throw that open to both of you.
Moussa, feel free to go if you have answer.
Yeah, I'm definitely not a banking expert, but I think it's.
But you were a banker, Moussa, so.
But definitely not. I mean, I haven't researched bank as much as Erica has researched banks, but I think, coming from the perspective of commercial real estate, and we need to understand that that risk is very concentrated. It's more concentrated on banks that were not really subject to stress testing by the Federal Reserve. This is also very important because, the requirement for stress testing, the threshold was increased, and other results that did allow banks as SVP and other smaller banks to really take a lot of risk in order to increase.
So Moussa, again, let me just stop you for just a second. Will you please explain to the audience what stress testing is and what determines whether you are tested or not?
Okay. Stress testing, this is following basically 2008. Okay, the Federal Reserve decided to pay closer attention to banks because we know banks how they behave. Okay, banks, they tend to take a lot of risk just for short-term profit. Okay, so the Federal Reserve that banks that can basically pose systematic risk to the system needs to be basically watched more carefully. What the Federal Reserve does is on a regular basis, the Federal Reserve, we basically look at the financial position of those banks. To make it simple, to just look at the financial position of those banks and see whether if there is a shock in the system, whether or not these banks will fail. Okay, so the Federal Reserve decided to basically focus on the largest bank. I think the threshold that was set by Congress was about, I think, $100 billion initially. Any banks higher than $100 billion will need to be stress tested on a regular basis by the Federal Reserve. Then what happened, a lot of banks that were right at 100 started lobbying to initially it was $50 billion, not $100 billion, okay? And then a lot of those smaller banks started lobbying Congress to increase that threshold, and then it was increased to $100 billion. One of those banks, guess what? SVP banks. One of those banks was also, the other bank that fell. Another result, there was really a regulatory failure there that would lead to that, okay? I understand that, a lot of these banks try as much as they can to reduce their costs by not hedging their position. And a bank, at the end of the day, all they have to do is really to manage interest rate risk at the end of the day. And for a bank not to be able to do it, it's just unbelievable. But I think we need to understand also we did create incentives for those banks to behave the way they have behaved.
I would like to follow up on Mousa's question, answer. I think that's a very good answer. In the second paper, we do try to understand why don't they hedge. I think there is a very canonical agency conflict, just like how we teach our undergrad here at Marshall. Banks would have incentive to not hedge enough, or they don't have incentive to hedge enough, given that they have limited liability, right? Just like what Richard described earlier, if the bank fails, then either the depositors or the government who is providing deposit insurance is going to cover the losses. And so, without any regulation, without any bank regulation, a bank would have incentive to take on excessive risk compared to the socially optimal level. Then that's why we have capital regulation, right? So we all know that banks are required to hold at least 8% or 11%, depending on the ratio you looked at, as capital. And the capital is going to absorb all of the losses, and presumably that could incentivize them to take on more hedging position just to insure themselves against interest rate risk. But the issue is really that if you use book value to calculate those capital ratios, then banks are essentially shelled from the interest rate risk. Like whenever interest rate increases, the market value is going to decline, but that is not going to reflect in the regulatory capital ratio, and therefore the banking regulator may not detect that as early as possible. And then, of course, there are also other macroprudential policies like Moussa described, like stress testing and things like that. But as a standard tool, I think it's very important to keep in mind that if banks are not asked to market some of the losses, and the regulatory capital may not be able to capture what's actually going on at the bank, and that actually defeats the original purpose of having such a capital regulation.
Well, so, one thing that occurred to me is one of the problems is the Dodd-Frank basically implemented the Basel Accords for the larger banks. It does not apply to the smaller banks, but it sort of gives smaller banks guidance about what the regulatory regime is. And what those Basel Accords did is they assigned different risk weights to different kinds of assets. And so Treasury securities get, regardless of maturity, get a zero risk weight, which means that you have a tremendous incentive for regulatory arbitrage, right? Because you're basically at the margin, not having to add any more capital if you acquire these. I mean, you still have to have your minimum capital no matter what, but if you acquire these as assets. And I often wonder if we need to revisit just the whole way we think about adequate capitalization in the banking sector more broadly, because I think maybe it's because we went through a period of 30 years of interest rate declines. What do I mean? 30, really 40, nearly 40 years, not quite, that it didn't occur to people that this could bite, but that 0% risk weight on long dated assets, no matter how creditworthy they were, strikes me as part of the source of the problem.
Yeah, not only capital regulation, I think there were also liquidity coverage ratio that actually incentivized the banks to take on all of those long-term and liquid assets. I think that goes back to Richard's earlier question about the difference between this crisis and the savings and loan crisis. I think back in 1980s, during the savings and loan crisis, all of those residential mortgages were not liquid in the sense that you could not easily sell them in a secondary market. But today, banks actually hold a lot of liquid assets like cash plus securities like treasuries and MBS make up almost the 40% of banks' balance sheet. But we still have this issue. And this is because of the interest rate risk, like what Richard described. And those interest rate risks are not properly risk weighted in Basel III.
So I have three questions on New York community banks. I'm going to just put them all together. And they sort of go together. Is it a zombie bank? Is it hedged? Tell us what you think, if you have any thoughts at all, about the bank that's been most in the news for the last week or two.
I will briefly revisit the point I made at the very beginning. So I talked about banks, I talked about commercial real estate. I think there is a very important connection between the two. The feedback effect. What's more concerning is actually two sides can reinforce each other. If you look at New York Community Bank, look at its performance back in early 2023, it was doing okay. It was doing relatively well, actually, compared to its peer banks. What happened is the CRE loans. It had a lot of CRE loans on its balance sheet, and CRE loans started defaulting. And then that essentially affected depositors' confidence on this bank. So any bad news at this time could trigger some panic run, and that essentially could lead to the problem.
Was there any thoughts?
No thoughts really. I think Erica is right. That's where the bank is. But I think also we just need to take into perspective, the interest rate environment and where we're going. Where the interest rates are likely to go going forward. And it's true that there's still some, risk in the banking system. But I'm not sure how significant that risk will be going forward, given that monetary policies are likely to be more accommodating.
So, well, every time they cut the rate, some of the pressure will be off banks, right? The question is, are they going to do it? And I've decided a while ago to stop trying to make bets about that one way or the other. There's a question here I just love, and if you don't mind, the story is when I worked at Freddie Mac, I remember having lunch with my team one day, and we were feeling really good because we worked very carefully on hedging interest rate risk, and we managed credit risk very carefully. This is before Freddie went nuts. I left before that period of time when they had a CEO named Dick Siren. And we were sitting around and I was saying, okay, what could go wrong? Okay, we've managed our credit risk well. We manage our interest rate risk well. What could go wrong? And by the way, we managed interest rate risk our aim was what was called a 1 month duration gap. So we wanted 1 month of duration remaining. And the reason it comes back to Erica's point is to get to zero is so expensive. You make no profit if you do it. You need a little risk to make profit. But basically it was we computed that interest rates could ramp up 600 basis points in a year, we would survive it just fine. Okay. And one of the guys who worked for me, a guy named Brian Surratt, who went on to run credit for Capital One, says, well, there is counterparty risk. And we were thinking about that. And so I said, and who is our biggest counterparty? And somebody else says, Lehman Brothers. And so we start laughing. Okay, everything's fine. We have nothing to worry about. And so that sets up this question from Lucas Duvall. What is your opinion of the counterparty risk for interest rate swaps? And Erica, I think that's probably for you.
That was actually the initial reason that we didn't consider hedging position in the first paper, because losses are losses. If banks don't bear losses, someone else, either other banks who serve as a counterparty or insurance company, just like what we saw during the financial crisis, they have to, like, to the $2.2 trillion losses that actually existed in the system, someone has to bear it. Right? So what about counterparty risk? There is such a risk, right? And so the question is whether it is managed by someone who is better at bearing those interest rate risk. For example, if you think about insurance company, their balance sheet look exactly like the opposite of traditional banks. Their liability has long-term, like most of their liability are like life insurance. And so those claims are long-term, and whether banks and insurance company can help each other hedge against the interest rate risk, I guess the answer was no, right? That's not what we saw during the financial crisis. If the insurance sector has to bear the risk, and then they would have to absorb it. So at the end of the day, $2.2 trillion losses, that's actual losses. It doesn't matter who is bearing it. That's why at the very beginning, we didn't really consider the interest rate swap positions. And then people really wonder who is bearing it. So then we dive deeper into whether banks actually hedge.
And do you have any sense of who is on the counterparty is well capitalized? So, I mean, the thing that matters is, yeah, the losses are losses, but if you have institutions that can bear them, the system doesn't fall down. Whereas if you have institutions that can't, like AIG, for example, everything can come unwound very quickly. So do you have any sense of that?
Yeah, unfortunately, we don't observe the position, like we don't observe
because it's over the counter.
Actual, it's over the counter. But there are some other research papers showing that insurance companies tend to buy duration, where banks tend to sell duration. In our paper, what we find is if we look at the total equity of the entire banking sector, I think the losses we document is around the ballpark of the total equity before the rise of interest rate. And so that means that the entire banking sector, if they perfectly hedge this interest rate against each other, they could barely absorb the losses.
Right. Yeah. Thank you. So here's a question that's a bit fraught. And by the way, to the audience, it's been great. The questions are coming in, but please feel free, if you have a question, to type one into the Q&A box. I don't know if either one of you are going to want to take this on, but I'm going to ask it anyway. Other than inflation, unemployment purposes, what incentives did the Fed have to raise rates so fast? And well, they aren't continuing to raise rates, but why did they? I think what the viewer wants to know is, why did they have to go so quickly?
Oh, I mean, I feel like they did the right thing given inflation was so high and unemployment rate was high, right? That was the main objective of the Fed. They have to stabilize prices. They have to lower employment. They have to tame inflation. If inflation was not under control, we have so many episodes around the world, like how things could go bad. It's just, they have to also consider systematic risk and financial risk.
Moussa?
My take is that, I mean, as she said, I think the Fed didn't have a choice. The Fed had to raise interest rate. But I mean, the question is whether that's the raise of interest rate that basically led to inflation going down. I mean, it's an open question, right? Because where was inflation coming from? I think a lot of the inflation was supply kind of driven. And once those supply kinks was basically resolved, it led to kind of inflation going down. And maybe right now, inflation is where, it's more demand driven and the Fed has to do something to kind of bring it down. I mean, but I agree. I mean, the Fed didn't have a choice than to raise interest rate repetitiously. So.
Well, and one thing is, I mean, as our friends at Penn State hammer on, is a lot of inflation comes from residential rents. And we had huge run-ups in rents during the pandemic, as much as 20% a year in some markets. That rent inflation has come way, way, way down again. And in some markets is actually negative right now, which is one of the things that's creating pressure on the CRE section. But that all seems kind of orthogonal to Fed policy. Sorry for using that word, independent of Fed policy to me. And what I worry about going forward is if we stop building stuff because interest rates are so high, we're going to see vacancies fall very rapidly again, and we'll see this cycle of rent increases again in a couple of years. And I don't know, I've seen various estimates of this, but what impact does that Federal Reserve policy have on the housing construction chain? And do they kind of undermine them at a certain point? Do they undermine themselves by preventing the new housing that needs to be built from being built? That's more a comment than a question, but if you have any thoughts, I would.
I think development activities have basically gone into a stop. This was since the third quarter of last year. And as you said, rent growth is going to be negative in a lot of markets, okay? But because of the fact that it takes time for construction takes time before it's added to the stock. But even in markets that did quite well, like, Austin and, Raleigh, North Carolina, a lot of those markets are expected to experience close to zero rent growth going forward. And the fact that, of course, what's happening, this is something we discussed in the Kasdan report, the fact that interest rate is so high, no more new construction taking place, expect rent to pick up in 2 years' time to start going up again. So, yeah, that's definitely the case. So the real estate market definitely will benefit from interest rate going down. But I think also we have to be honest, real estate investors have been just used to very low interest rate. And they need to understand that we are not going back to getting a mortgage for 3% to do development. That's not going to happen again.
So I think Anita Weaver has an interesting question. Are there specific sectors besides multifamily within CRE that you believe will be more resilient or even thrive in this new, and I think I'm going to infer interest rate environment?
That's a good question. Actually, when we were looking into all CRE loans outstanding, we have offices being the worst player in this market at this moment. Multifamilies are the second. We have retail, we have a couple others, but I didn't see which sector is actually doing better than before. I don't know if Moussa has any insights on this.
The most resilient right now has been industrial sector. And the industrial sector has outperformed multifamily and will continue to probably outperform multifamily for a while. Nobody wants to touch office. Office and retail.
Yeah, because that's fundamental, right? That's not the interest rate environment. And it's just people
that's
don't.
Not exactly, I agree. That's the fundamental. That's not the interest rate environment. To some respect, also retail is the fundamentals, right? Okay, because retail also experiences quite a lot of default. Okay.
But one thing that has occurred to me on industrial is very often industrial real estate will sign very long-term leases with some escalators, but kind of limited escalators in them. So flat rent for 5 years, then a 5% bump, and then another 5 years of flat rent. Moussa, that's a very common lease structure for industrial real estate. Aren't holders of industrial real estate to some extent like banks, is if their loans are mismatched to their leases, even though they're completely full? And by the way, because the Port of Los Angeles is probably going to do really well again because of the Panama Canal drying up and so on. So you're going to fill up the space, but doesn't this create a risk for that sector just because of the nature of the leases that they have?
Moussa, you mentioned something about the loan terms. What I was aware of was many of those loans, they could have long terms, but they actually have variable. They're like their rates are floating in some sense. So it's true that it could keep getting those loans, like they don't have to repay until a couple of years later because of the long maturity, but I don't know how many of them actually have fixed rate as part of the term. If it's variable, what we did is to recompute the new interest payments under a different interest rate environment, and then we can look at their operating cash flow, given that operating cash flow are either negatively impacted or not affected. For industrial, there is still a concern that the debt coverage ratio could be very low. But that, maybe Moussa, you can talk more about.
That's a very good point. That's a very good point, because we tend to just think about the refinancing of the balloon at the end, the refinancing risk. But also there are a lot of loans out there that are adjustable rate loans, and they have and those payments have been increasing and basically, eating up a lot of their cash flows. But we don't know. We don't know exactly what's happening with those loans. But if you look at, for instance, the only information I have seen, it's really performance information I have seen is from from TREP on the CMBS side. But definitely, default have gone up for multifamily, for instance, but still not that significant. But multifamily right now is sitting at 2% default TREP. But again, we need to be very careful because CMBS is not that representative of the commercial real estate market. It would be interesting to see exactly how banks are dealing with that, because maybe some of those borrowers have already not met some of the financial covenants that are, of their loans. I don't know what banks are doing right now about that, but that's definitely something that's out there. That's a risk.
So I have a couple of questions on debt funds, and they're coming from opposite ends of thinking about them. So I'm going to ask you two questions about debt funds, and they contradict each other. The first, an anonymous attendee says debt funds have been a large player in the real estate world over the last few years. At this time, we don't hear much about their distress, but any sense of how that might play out. But the flip side is someone saying, what role can debt funds play in acquiring distressed real estate? How does this affect the market long term? So debt funds, problem, solution, both, neither. What do you guys think?
I will ask a very naive question. What is debt funds? Is like private debt or is non-bank
private
funding?
debt. So basically non-banking.
It's different terminology.
Yeah. So private debt.
There will be opportunities there definitely for debt funds, right? But again, I'm just not sure how many owners are going to end up losing their properties. Debt funds may be, where they may find more opportunities these days. It's in the office sector and potentially using those offices to do something else with them if leases don't materialize. But I'm really not sure, because what we're seeing right now is that, instead of debt funds, but I think what we're seeing right now is opportunities really for mezzanine financing, for instance. Okay, because a lot of these owners who cannot get enough money to really refinance their loans may need some additional gap financing from mezz financing. Maybe debt funds can play in that space as well.
Ultimately, private debt also have to come from somewhere, right? So if the conjecture is they are funded with long-term debt, so they don't have interest rate exposure, that's good. If in some sectors, actually in the residential mortgage sector, many of the non-bank lenders are funded by traditional banks, and also they're funded with short-term funding. So I think the debt structure of those debt funds, so there is also a capital structure of those lenders as well. And what's ultimately going to be important is how they're funded and where their funding come from.
So here's a question from Jack Harding. Given that rent growth has flatlined, what position do you think multifamily developers who have just finished construction projects are in?
They're in a very tough spot because rent is not growing and cap rates are very high because of higher interest rate. And as a result, the value of those properties are basically down. So the best solution is, if you can operate those properties, wait for the market to improve a little bit, probably that's the best thing they could do. But if they end up having to sell, they will basically sell at a loss. And I don't know exactly, how they can, survive that. A lot of developers may go underwater as a result.
I'm going to ask you guys two more quick questions, then I want you to close with one thought. The first question is sort of unfair one, but do you have any thoughts on the ocean-wide fiasco in downtown Los Angeles?
I think the only good thing is that probably it's not US money, right?
Yeah, exactly. Yes.
I think that's the only good thing I see in it, because those properties will be sold at a huge discount.
Okay. The other thing is, I thought this was a really good question is, okay, these interest rates are having these enormous impacts on commercial real estate, but the residential market seems to be going along more or less just fine, right? And you look at things like mortgage delinquencies, they're nearly non-existent. And I know I have some views as to why that's the case, but I'm not going to share them. What do you guys think about that? Why do you think the housing market, the for sale market seems to be doing just fine?
So I think there are a lot to share about the residential mortgage market. First of all, most of the residential mortgages are 30-year fixed mortgages because they're backed by the GSE, the government-sponsored entities. Also, there were huge forbearance money devoted to the space during the pandemic. And then at some point, there were a lot of discussions about how exactly we can, going back to the normal state, like once the forbearance ends, what's going to happen, and banks actually help them restructure those mortgages. And so everything was quite smooth. We didn't see a spike in foreclosures during the pandemic. And now when interest rate goes up, it's people, like many of the home buyers during the pandemic actually got a super low rate. So locking the rate, they are now going to sell their house in the next couple of years, possibly, like because they lock in like 2%, 2.5%, and I don't think any of those home buyers will sell. And I think the question today is actually we don't see that much transaction volume going on anymore. So I don't think that is the mortgage is the problem is not in the mortgage space, is rather in the commercial like in the housing market, like whether those people are going to sell, and what if they don't sell, like where the supply is going to come from. I think those are the questions that I have been discussing with people.
Moussa?
No, I don't have anything to add to that. I think, the housing cost is very low because they have locked in very low interest rate, as Erica said. So it's not surprising.
Okay, so I want to finish up with a question that is a non-academic question. It's the sort of question you see at real estate conferences, industry conferences. So on a scale of 1 to 10, how worried should we be about the banking sector, and very briefly, why? So I'm going to start with Moussa, and then we'll finish it up with Erica. So Moussa, on a 1 to 10, 1 is not worried at all, 10, oh my God, the world's coming to an end. Where are we right now?
I think I'm at a 3 or 4, and we have kind of had this discussion because I think we are almost at the tail end of the monetary tightening. If not there, I understand that there are a lot of losses in the system that's not unrealized losses, but I don't think those losses will be realized at any point anytime soon.
Erica?
I'm less optimistic. I would say 6 or 7. I think one thing I didn't get a chance to discuss is Fed actually injected a lot of liquidity during this period. And we had a term funding program, and many banks actually borrowed from the program. That program is going to end soon, and banks. So it's going to end soon, but it doesn't mean that banks have to repay. But that also means that they are still subsidized, that they are still getting the money at very cheap, at very low rate, and they don't have to repay. So I think that worries me. It's just
it's still the federal funds rate that they have to pay, right?
Yeah, exactly.
So it's still more than they're collecting on their 10-year treasuries that they bought in 2021.
Yeah. Even though, I mean, they would have to eventually repay it, and when it gets to that time, how does the market rate look like? I just don't have a good forecast on that.
Okay, so Professor Erica Jiang, Professor Moussa Diop, thank you very much for spending an hour with us at Price Presents today, Debt Markets and Development. And to the Price team, is there anything else I need to do? Oh, let me thank the Price team for organizing this and doing such a fine job making sure the technology works properly. So Giovanna, Lance, thank you for all of your help. And do I have anything else I need to do? Okay, I'm told I may sign off. Thank you all for joining us today, and we look forward to seeing you again soon.